many good friends in the audience, so I just want to recognize, Susan, Subrata, Vijay, Ajay. So thanks for having me on this. Really nice to be here, and I know especially following some very good set of papers, so I hope I can add value. This paper is actually joined with Sanjeev, who's at Santa Clara, and my colleague Sub at Laurier. I think the sort of, I only have 15 minutes, so I'm just going to keep it very simple. So I have this big agenda, but basically I'm just going to talk about introduction, motivation, and probably directly go to summary after that. Okay, so the basic story is really this: that what is systemic risk, right? So this is Billow et al. JFE paper 2012. Sort of breaks down the systemic risk into 3 or 4 dimensions, which is really about quick propagation, right, of these illiquidity, insolvency risks throughout the system as a whole. So there is a holistic aspect there. And then it also impacts the connections and interactions, right, among FIs. So as a result, there are really 3 aspects to systemic risk, which is really this magnitude, the widespread nature of it, right, and the ripple effect. Now, that also means that it is slightly different from systematic risks, right? So the 87 crisis was a systematic risk event affecting the asset correlations across the space, whereas the GFC was more of a systemic risk, and primarily because it impacted some underlying linkages, and that manifested through sort of potential vulnerabilities, right? So either you're looking at weak financial firms, substantial interlinkages among them, complex financial products, excessive leverage, right? Spanning, different maturities, and funding mismatches, right? And the shadow banking system. So we've heard enough of these, but these are the sort of fertile setting ground for the systemic risk to develop, right? So in this paper, what do? We simply undertake a large-scale empirical examination of systemic risk among major FIs in the emerging markets. So the key operative word is sort of large scale. So as a result, we sort of do a comprehensive study of joint evaluation of systemic risk, tracking the underlying network relationships, and also the default risk characteristics. So as a result, we hope to provide some shared new insights into the measuring, managing, and regulating aspects of the systemic risk. Now, I think the key word is, again, a multivariate system, right? So the financial risk evolution in emerging markets is never an isolated event. And this is usually reflected as a joint phenomenon. And we all know this. And so obviously then this translates to a framework where we need to have a dynamic relationships of systemic risk over time and cross-sectionally incorporated into the study, right? This is a picture taken from JFE Billow et al. That I referred to earlier, where they actually have a adjacency matrix. So think of it as a network matrix across the top 25 FIs in US. And this is based on a certain time scale. So usually this is indexed to a certain time, but let's say on average, you have these complex networks which are driving FIs, right? And those complex networks are really sort of cross-sectional relationships, which could be very much at the heart of systemic risk modeling, right? That one needs to incorporate. So we take that Billow et al. And sort of extend it further and towards a systemic risk, which is network-based. So broadly speaking, systemic risk could be sort of traditional tail measures, which could be backward-looking, or a forward-looking metric such as network risk. Now, network risks also model the underlying mechanics of the system. The earlier diagram showed you, but decomposing the systemic risk into a network effect and that of an individual bank risk. So a cross-sectional relationship is something that you can divine from this. So just to give you a preview, so this is Sanjeev's earlier work where the key variable output is S, systemic risk score, but what goes into is A, that wonderful picture you just saw, but we augment that further, the adjacency matrix, But then we also augment C into this. The vector C captures the probability of default, a forward-looking measure of a bank, as well as the size of the bank. So we're sort of putting a complex variable together, S, where we are squeezing a lot, which is really about complex networks, about the individual size, about the probability of default, which itself comes out of a reduced form, a complex reduced form model. So overall, we feel then that once we get such a aggregate S, we can actually then decompose it into an individual level, right? So that is also the richness of the model. Now, having equipped ourselves with such a robust systemic risk, network risk measure, then we sort of, related to the previous literature, which sort of looks at either cross-sectional correlation measures or the network measures, right? And on the right, you see that the network measures actually have been used, allows regulators to estimate how the distress of a given firm would directly affect the other firms in the network. And that is the sort of literature we sort of, we stand on to contribute for. Now, overall, students of macroeconomics would understand that there are 4 sources of systemic risk, which could be banking-related panics, banking crisis arising from falls in asset prices. So this is the asset side of the balance sheet, or contagion, which is sort of happens to foreign capital flows, once they pull out suddenly, or FE, foreign exchange mismatches, right? So all these shocks overall would lead to asset price declines. Our network measure actually helps capture such intricate relationships across it. Now, we accomplished 4 broad objectives in this paper. Measurement, right? Decomposition, dynamics, and prediction. So we sort of measure systemic risk using data on financial entity linkages, right? And respect to credit qualities. We decompose such risk into various components, and then we sort of study the spillovers, right, across the markets. And we also try to arrive at a small predictive model that could be of help for macroprudential regulation. Why emerging markets? Well, I don't have to motivate this to the audience here today, but there has been a significant growth in emerging market debt, as we know, post GFC, mostly in the non-banking financial sector. And that in turn has heightened credit risk impact on the emerging market borrowers. And that has manifested through underlying interest rate, rollover, and currency risks. And finally, that was also because these banks, local banks, are interlinked to such foreign borrowers, rather borrowers who are borrowing in the foreign market, the local banks are also get plugged into this, and that manifests as higher risk for the local banks that have exposure to such firms who borrow internationally. So on a more mundane front, this is an article from Journal of Financial Stability, 2017. It sort of counts the number of articles on systemic risk. Obviously, there has been a steep spike post GFC on this. But actually, if you look at how many articles were there on emerging markets, there are only 3-4 papers, right? So and sort of just to give you a little bit of feel, there is enormous literature. Previous literature has, in the context of developed markets, has looked at the asset pricing implications of systemic risk, cross-sectional sort of institutional differences in systemic risk, the impact of systemic risk on real economic activity, and the actual of the mitigating effect of capital flows on systemic risk, and so on. I know a lot of these others, which is why I put in there. But then, if you look at the emerging market, most of it has gone into Journal of Financial Stability Emerging Market Review. They have looked at a certain panel of emerging markets or certain unique countries such as Turkey or China. And the story there is really about how the systemic risks matter in emerging bond market returns, or how the institutional ownership can actually lead to enhanced systemic liquidity and thereby increasing the commonality in liquidity, right? So, but I think, and there is little work in Indian context, which is very important. I know Susan and her team have been working on it, I believe. So I think we are all in this sort of trying to understand how these systemic risks work across the space. So really our contribution here is a comprehensive analysis of systemic risks in emerging markets. And we extend the literature by incorporating credit quality information in order to compute a single S score, somebody says systemic risk score, that can help capture the market dynamics. We hope.
Madhu, you have 3 minutes.
contributions. So thank you. So our contributions actually serve that of regulators and so on. So 3 minutes is a lot. I think you can do a lot of things. So basically, the key findings are really about these 4 things. So let me just hit the main points. We sort of clustered the markets, 23 emerging markets, into 5-6 clusters there. So just let me point out. So this is one picture that comes out of the article, manuscript. We sort of looks at a cross-sectional diversity. So just sort of, I'll put my finger on South Asia, number 2 there. The line in blue, which is sort of a, which is India, really, the Indian sample. And what I want you to see about Indian sample there, South Asia, is that you don't see any noticeable spikes in systemic risk in South Asia at all during the GFC. But what you saw there was a big spike in it during the taper tantrum, right? And you see a big spike in it in the currency crisis. So right there, you see how South Asia or India reacted so differently from rest of the emerging markets, right? And there are a lot of interesting stories we say in the paper. So I will probably have 1 minute. So I'm just going to quickly summarize. So, so then we talk about the broadly talk about the timing of systemic risk, how the concentration. So we talk about the final index. We talk about the fact that we can actually decompose the systemic risks into credit and network effects, which explain about 66-70% of the total risk. Then we talk about the lead lag relationships. Basically, the story there is most of these lead lag spillovers actually are contemporaneous. So within the quarter, the information spills across emerging markets pretty quickly within the same quarter. And most of the relationships tend to be, within each region. So we sort of tease that this lead lag effects there. I just probably have half a minute, so let me. And then we look at a PCA. This is very interesting. So we sort of break this PCA. So take all the systemic risks of all the emerging markets, break it down. We actually identify 3 PCs, right? Principal components. The story there is the first principal component invariably is related to the default risk in the US. The second principal component is sort of related to the policy uncertainty, as well as the euro crisis. The third principal component seems to be the funding risk, as we see in the US. So there are actually nice ways to sort of think about this risk that we document. Finally, we sort of present a model where we can actually predict the firm level probabilities of default using lagged systemic risk. And that, I think, is a very important sort of channel. We think our systemic risk measure can actually help regulators to sort of come with a prudential regulation, right? So on that note, so let me sort of finish it. And we contribute this. Thank you so much, everybody. And I want to particularly thank Bhavya, who is probably given a short notice to discuss this paper. So thank you.
Yeah, can we have Bhavya with the discussion?
Sure.
So I need to disconnect. Is that correct? Yeah.
Yeah. You stop sharing.
Right. Can everyone see my screen?
Yes,
yeah.
Okay, great. So hi everyone, I'm Bhavya Sharma. I'm a second-year graduate student at the University of California, Santa Cruz. Firstly, I would like to thank the organizers, Ajay, Susan, everyone, for giving me the opportunity to read and discuss this paper. And it's great to see everyone, Professor Sarkar, all my other ex-colleagues. I'm glad you're all doing well. Right, so let me just start by first congratulating Professor Kalimapalli and his co-authors on covering such an important empirical work on systemic risk movements for emerging market economies. Especially, this is especially useful given the limited research on EMs on this topic. their main contributions come from three fronts. First is their measure of systemic risk, which allows for disaggregation into credit risk and network risks, and they do it for a wide breadth of financial institutions in emerging market economies. The second is the examination of the macroprudential linkages between potential default levels and current systemic risk metrics, which has a lot of policy, like useful policy implications for regulators and regulators, practitioners, and academicians equally. And thirdly, and this is something that is personally I personally appreciate it as a student, is that the analysis controls for relevant firm level balance sheet information, which is somehow in a lot of discussions of systemic risk and financial networks, this is something that that's not always covered. So so that way, this is a great paper. And also macroeconomic info. The fact that the measure of systemic risk allows for an interaction of both the probability of default, which is a firm specific characteristic, and the overall network, which depends on correlation of equity, the Granger causality of equity returns, I think is a very useful addition. Great. So I'll quickly go through the main results. Firstly, there's significant heterogeneity in the evolution of systemic risks across the emerging markets, across three different periods of volatility. Secondly, there's a high degree of concentration of systemic risks among major banks in each region. Thirdly, the credit risk and the network risks together explain the majority of the variation in the systemic risks. And there are other main results too, but the fourth most important result, in my opinion, was the discussion on the contemporaneous and lagged effects in systemic risks and raw correlations, and the spillover effects of systemic risks across regions, which is weak. All right. On the comments. So my comments are structured in a way that they allow for a little bit of what possibly could be changed or could be made better, along with what are the other questions that can come out of this particular research. Okay, so as a student of macroeconomics, after I saw the title, my first question was, where do credit cycles fit in? Right? I would suggest that the paper can be better situated in the credit cycles and systemic risk literature, with a little bit of discussion on the interaction between the network effects, which the authors have already calculated, and the region-specific or country-specific, if the data allows for it, credit market conditions. All right, because otherwise there's no specific discussion of credit cycles in the paper, even though we talk a lot about the evolution of the systemic risk dynamics. Right. The second is, since we're talking about network structure, which has been so calculated on the basis of the Granger causality results between equity returns. There's something of major banks, something that is important is how does the topology of that network changes over time, right? So let's focus on the first thing. We have too big to fail, and we also have too central to fail. All right, too central to fail means that some banking institutions can be so much at the center of the network that their collapse can lead to a cascading effect of collapses. If anyone is interested, there's a very good paper by Golub et al. In 2014 discussing the importance of cascades and integration. It's a theoretical model that they have applied for Europe, but it's something that can be probably done now for EMs as well. Okay, so I would like to see a focus on global systematically important banks and their impact on regional banks. And their impact on regional banks, and how one adverse shock to one of the GSIBs could have impacted the regional banks. Any region would work, but it is important to show how these shocks basically travel. The second is that Okay. Oh, yeah. The second point is that the first three principal components are tied to US default and exchange rate shocks and policy uncertainty. Now, since the major variation is coming from factors related to the United States, I would suggest adding a control for foreign funding or cross-border borrowings of these financial institutions into your panel regression to make sure that the control is also taking into account foreign denomination of liabilities. Thirdly, and this is something that is very important, is the heterogeneity of financial institutions. So the general wisdom is that the banks in emerging markets behave differently than banks in the developed economies during the 2008 global financial crisis due to tighter bank regulation. So that is heterogeneity that is specific to the region and the level of development, financial development of the economy. But what is crucial now is what is the distribution of risk-taking behavior in the financial institutions in the emerging market economies. Okay, so on that account, an important theoretical paper is by Coimbra and Ray of 2017, where they show that the dynamics of distribution of leverage across intermediaries is a key determinant of financial stability. Okay, now with respect to the empirical work on networks, we see that core banks are more densely interconnected, which could mean that there could be a possible correlation in the default risk as well. Okay. What this could mean is that there could be a collective moral hazard problem where all of these core banks have a collective higher risk-taking behavior, thereby leading to an increase in the systemic risk. So there are two things. Firstly, in the panel regressions, the contribution of the bank to the systemic risk, or the change of the contribution of the bank to the systemic risk, is a dependent variable, and the bank specific characteristics are the explanatory variables. But if the dynamics of the evolution of systemic risk are affecting the risk-taking behavior of the banking intermediaries itself, then this could mess up the interpretation of the regressions, and that could also lead to endogeneity problems because Y is determining X as well. So if there's a way to deal with that kind of situation, that could be great, and that would also take into account the possible endogenous leverage choices that banks make. Secondly, a lot of important banks are covered by limited liability provisions or bailouts. So accounting for those country or jurisdiction specific limited liability provisions in the panel regressions that are covered in the second half of the paper could be very useful, and it could probably add some value to the causal interpretations or the explanatory power as well. This is a more general comment. Risk dynamics also depend on informational asymmetries, meaning that the banks which are at the core might have a higher amount of information related to interbank exposures, whereas the smaller banks might not have a very might not have a lot of information about bad loans or bad credit exposures. Okay, so in that case, what happens to the systemic risk in those cases is a very important and interesting application that people have increasingly started putting some research in, and this paper and the metric developed in this paper could also be used to study this particular question. Finally, I'd like to come up on the question of the measurement of the networks. So first is the statistical robustness of links that I want to talk about. I could not find out the adequate explanation of this in the paper, but the returns that have been calculated or that have been used for the Granger causality analysis, have they been calculated with or without the effect of the market mode? Market mode meaning the general benchmark index or so on. And secondly, the network measures that are reported, just a second. Yeah, the network measures that are reported are average values aggregated over the time periods, over a large time periods. For example, the last time period is, I think, 2006 to 2010, basically 3 to 4 years. So I would also like to see some robustness measures of the statistical reliability of the networks. For example, looking at bootstrapped measures of centrality and bootstrap measures of network risk. Thirdly, different institutions might react differently to the same exogenous shock. So it's useful to check the robustness of the systemic risk metric to an extreme adverse balance sheet shock versus a moderately adverse shock. This is more related to the tail risk measures. So it's not very crucial for the paper, but just for the sake of seeing the robustness of the metric to extreme shocks, it might be useful. That's all from my end. Thank you, and I hope that these comments will be of some value to the presenter.
Are there anybody with a question?
Can I ask the question?
Please. Yes, please. Go ahead.
I'm not a question, mostly a comment. See, it's a very nice paper. Madhu, of course, for this you have to drop one measure of systemic risk, because and that's why you use that formula. What is 1 by n square root of CTA, and then you have size, weighted, and all those things. See, one thing which Bhavya was also pointing to. So first we have 4 types of agents, I think: banks, then banks and brokers, and whatever, 4 types of agents basically. So the systemic risk measurement, which is your main variable, is actually an interplay of these 4. So when we get the result, we do not know who is actually causing it. It is because it's all subsumed under S, right? Yeah, I mean, but that's what we have to do, because if you want to measure one variable of systemic risk, we have to combine. So I have no quarrels with that. But as Bhavya was also saying, that in this network theory, there is always this idea of a core. I mean, a big node is there, and I mean, a big necros is there, but that network is actually driven by 3 or 4 sort of mother nodes. And if one of those nodes collapse, that collapse is not the same as if another node collapses, which is in the periphery. So there is this percolation theory, which is that how robust is this network, that can be done by removing certain important nodes and then seeing whether the network still retains the property that you have done. So this is more like the construction of your variable. So for example, if you look at the NBFCs in India, just a point, for example, there are hundreds and hundreds of NBFCs in India. But if I take out an ILFS, for example, which I took out, then hell breaks loose. However, if I take out one guy from the periphery, then it's not the same. Now, under the S measure, it is not there, right? I mean, and as you observed in India, for example, we are having a lot of banking crisis problems. But it is always whenever, for example, if State Bank collapses, I mean, State Bank will never ever collapse, because if State Bank collapses, everything collapses, right? Like an LIC will never collapse, because of course LIC is in pink of health, but government is trying to sell its shares. So that somehow should come into your picture, because it's already a collection of 4 types of agents, and then within each side of agent there are big nodes. So result is good, but if as a policymaker, if I want to take an intervention, then I have to figure out what to. I can pass a general regulation, but a general regulation is not that effective. I have to target UTI, Axis Bank, or something like that. So maybe it will be nice to study the network composition that you are getting. After that, the results are. I mean, every empirical paper has its plus and minuses.
Can I respond?
Yes, please. Yes, please. You have you have a few minutes.
Yeah, no problem. So thank you so much, Bhavya. I think tremendous work. Especially being a student and doing this at a sort of short notice. I really acknowledge your input. So I think so that is the beauty of the framework, right? So the framework is pretty robust. So I can actually get down to a bank level. I only can consider banks. I can only consider broker dealers. I can only NBFIs. I can take them out. So the framework is very robust. A and B is the sort of the shocks, right? Which is sort of clinical analysis. I can include a ILFS and take it out, etc. That can also be done, right? It's very robust. So to that particular question. So I think there are wonderful stories to be said out of this framework, and the contribution of the paper is not theoretical. In fact, Sanjeev had a few theoretical papers that preceded this. So, and we sort of took that theory and sort of put it to test in some sense. So, and I think this is a framework where anybody else can take this and do exactly those sort of scenario analysis to the benefit of the regulators, no doubt. Okay, one more minute. So, and I think so. They're all absolutely can be handled in this framework, without doubt. The credit cycles, yes, it may be misleading. Right now, we are just thinking about macro factors in there. We included local factors and global factors, risk factors, but definitely we can do more than that. We were actually trying to put a comprehensive model together, and we're struggling with the right word. So well taken, Bhavya. The too big to fail, yeah. So the point here is not only we get an aggregate score by compressing all the information, but we can take that aggregate score and decompose it back into each banks. So we can actually get an individual bank level systemic score too, not just aggregate, right? And I think that is also a sort of beauty of this approach, where we can just take only a certain subsegment, which is banks or broker dealers or NBFIs, and calculate a firm level systemic risk, which can address your too big to fail sort of question. And we have seen that SBI is not necessarily the center of the core network just because it's a big bank. It may not have that many networks across. So we get some interesting results on that front. I can say more about that. The PCA, yes, it's sort of we let the data speak there, and the foreign debt funding. So we sort of proxied for the TED risk, which is the funding liquidity risk out of US. So I think that seems to pretty much carry it. That probably would capture some of the funding risk you're talking about globally too. The heterogeneity, yeah. So we can put more variables into it, institutional details. Absolutely, Bhavya, you're absolutely right. But at some point we have to stop. But you're absolutely right. So we can make them more robust, and so on. So I think I think the key point Subrata was trying to say was, can we break it down at a firm level, and we can sort of disaggregate to a firm level to the point that we can actually do this sort of scenario analysis. I think it's robust. We have not done this in the paper because we had to stop at a certain point, but absolutely it can be handled. Thank you, Bhavya. And
okay. Thank you. Is there anybody else with a question?
Harsh, can I take 10 seconds?
Please go ahead.
Okay, this is nothing to comment. This is to only congratulate Bhavya. Bhavya is our student from IGIDS. So I am so happy to see the level of discussion that she has done. So it is a great paper by Madhu, and it's a great discussion by Bhavya. So that's all I want to tell.
Okay, thank you very much. Is there anybody